Chapter 5, Market Structure and Firm Performance. Welcome to the core of microeconomics from point of view of businesses in our book Economics for Business, because this chapter is about making profits. It's about the decisions of firms, and these decisions are guided in a strong way by the intention to make profits. We will find some things back, some analyses or some topics back that we already started in chapter 3, and we are going to do the theoretical derivation and talk about the theoretical aspects of profit maximization. This first part talks about the first 4 sub-chapters of chapter 5, which is the general introduction, profit maximization, a spectrum of market structures. And that means we will see that the ability of a firm to make profits and to maximize profits depends on the environment of the firm. It depends on the market, and we call this the market structure. Whether the firm is alone, then it's a monopoly, or whether there are a lot of firms, many buyers, many sellers, which we then call competition, perfect competition in the ideal case. And these two extremes, in fact, we are going to discuss in this chapter. Perfect competition in part 5.4. And that ends the first video on chapter 5. And then the second video of chapter 5, it will be monopoly and other aspects to be discussed. But first of all, we have to lay the basis of profit maximization and understand especially revenue, the different types of revenue, total, average, marginal revenue, in order to come to our profit maximization. Profit, the economic theory, the problems why firms maximize profit by using the point where marginal cost equal marginal revenue. This is a question that you can already answer in the meantime. We discussed it relatively intensively in chapter 3. The perfect competition, as I said, as one of the extreme cases and the one we are going to deal with in this first half of this chapter. And then a bit more about profits, this differentiation between normal and supernormal profits that we are going to define later on. How profits and losses lead to entry and exit into markets, what happens in monopoly where you typically have barriers to entry. We come to this in the second part. The first part, business problem, making profits. How can you make profits? How large will profits be in a particular market? And are some markets better than others? So these are leading questions that we come to in more detail when we go into the different parts. But you know, when you want to know more, that this is the presentation, there is also the book, and in the book you typically find more text explaining also these general things, whereas in the videos we more talk about the concrete technical issues. Like profit maximization. Firms are assumed to be run in the interest of their owners. As such, firms are assumed to be profit maximizers. That does make sense in most cases, but it depends on the owners. Are the owners shareholders that basically only have the view towards maximizing their revenue, maximizing the return on investment? Or are owners, individual owners, families who might have other things in mind? Nevertheless, in most cases, firms are, in fact, seeking to maximize profit. That's the job of the firms, we could say. And we are going to look closer at this. The maximum output occurs at the output level where marginal revenue equals marginal cost. Why? As I said, we discussed this in chapter 3, and if there are questions, then let us discuss this in class. And that brings us to this slide, a slide that you already know, where we said profit is revenue minus costs. So total profit is total revenue minus total costs. And from this, in fact, deriving that function, setting the first derivative equal to 0, we derived marginal revenue equals marginal cost. So in order to come to step 4, profit maximization, we need to understand total revenue, and that's what we in fact are going to do in this chapter. Before then we come to profit maximization. And total cost we already did. We did both in chapter 3. We discussed and understood cost functions, the different cost functions. Besides variable and fixed cost, we also talked about total cost, but average cost, marginal costs, and bringing this together. The cost functions we derive from the production functions at the beginning of chapter 3. So enough for the review. Let's go into our analysis of total revenue, which is the piece that we still need in order to be then able to say how to maximize profit. Total revenue we defined is quantity times price. Average revenue is total revenue over output, so the revenue per unit produced. And marginal revenue, the additional revenue from selling one more unit. All these concepts you are familiar with all these concepts as we discussed the concepts, the different levels in chapter 3 when we talked about costs, and partly also in chapter 2. So let's first of all look at these functions from a purely theoretical point of view. In order to understand the relations between the different concepts, it might be best to start with a numerical example, which we find in our book in table 5.1. And before I start to draw and have my strange shapes on the paper, here we are going to change to Excel and look at the concrete functions that we can observe. And then we can, once we have it, interpret this. You find this Excel file simply called chapter 5, as usual in our Allis group in the additional material part. You see the table here, and then you see that I put the same numbers in there. I inverse the sequence because this is easier to show here in the graph. But it's the same. You have prices between 0 and 13. Here it's only between 1 and 12, but we can use the extreme points in order to show where the graph in fact starts and ends. And that brings with it that we have the quantity, again, not from 1 to 12, but from 0 to 13, up to down. And that is already our average revenue curve, a linear function with A and B, so average revenue is A plus B times quantity. And this is now the graph. Average revenue or price is a function of quantity, is this graph that we show here. Generally, we can say on the horizontal axis we have the quantity, so we go here from 1 to 13 in our example. And on the vertical axis, we look at monetary values. So we can look at prices, we can look at revenue, also the different average revenue, total revenue. We will see if we add total revenue, then the scale changes a bit or substantially. But this is sort of the monetary axis. So what we have here is our average revenue function. Average revenue starting here at 13 at A plus B times Q, or in fact, let's this time say minus B times Q to clarify that this is a downward sloping line. We might note that this is the other interpretation in the chapters before, especially chapter 2 and chapter 3. We talked about quantity depending on the price. So the function, the demand function, which is the same thing that we see here, the interpretation of the demand function was up to now quantity is A plus, or in this case, let's say minus A minus B times P. Quantity is A minus B times P. I wrote chapter 2 to 4, although already in chapter 4 we started to understand that it's a simultaneous process, that the quantity the price determines the quantity, but also the quantity determines the price. Here we have another viewpoint. We have the viewpoint from the firms. The average revenue, represented by the price, the average revenue, is a downward sloping function, is A minus B times Q. So what happens if I have such an average revenue? How can I compute the total revenue that we just learned on the slide before? Total revenue is quantity times price. How does this look like? So perhaps we first of all write down this function. It's quantity times price, so it's quantity times A minus B times Q. And if we multiply this, we come to QA minus BQ squared. Recalling quadratic functions from school, f of x is x squared, then we often had parabolas for this. Or if in this case there is a minus in front of the x squared in maths, or q squared here, that is going to end up in an inverse parabola. And let us compute the numbers and check whether this intuition is correct. Total revenue is price times quantity. So when I go in here, I can type equal, and then I just say 0 times 13. The result will be 0. It's not that surprising. Here I say is 1 times 12, which is 12. 2 times 11 will be 22, and so on. So we can copy this function down, and we see for quite some time when the quantity goes down, so basically when we start from here, the total revenue in fact goes up. But we will also see that this only works until a certain point. Also 42, it still goes up. But 6 times 7 is obviously the same as 7 times 6. So when we further increase the price or decrease the quantity, then we see that it still stays 42. And if we continue our series here, then in fact we see, yes, it is. The shape is an inverse parabola, and our total revenue does have a well-defined maximum of 42, or even if we had units in between, we have the 242 values here, so it might be a bit higher between 6 and 7, but for us we can say 42 is our maximum. And that now is an interesting message for the firm. It says you cannot increase the price without limit. Yeah? When you start increasing the price, then also your total revenue goes up. But at a certain point, when you increase the price too much, then the quantity goes down, and that is where then the total revenue starts to go down. Which is, by the way, a story that we have been discussing in chapter 2, where we talked about elasticities. And we said there is a certain part of the demand function where we have an elastic demand, and there it makes sense to go down with the price. And then there is another part of the demand function where we have an inelastic part, and then it makes sense to go up with the price. Let's analyze this a little further by, first of all, completing our table. And we see here in the table, I just copied this, average revenue and then marginal revenue. So that this average revenue is total revenue over quantity. So when we do this, we are going to reproduce the first column, which is also already labeled average revenue. So when we say total revenue divided by quantity, then it starts at 0, 12 over 12 is 1, and so on. So when we copy this, we come to the same values, the same functions here. But that was only a step in between. What we would like to know is marginal revenue. How does this change in total revenue look like? And in fact, we can again sort of do this theoretically here before filling in the numbers. So when this is total revenue has this function. Marginal revenue is the first derivative of total revenue. So MR is the derivative of this. And if we think about, okay, how do we derive such a function by Q, then we might recall that this Q goes away, the A stays there, minus B times, and then this 2 goes down, minus 2B times Q is our function for marginal revenue. And that in fact will be, or is a general rule, when we observe average revenue equals A plus B times Q, and we have a linear function like in this example, then always marginal revenue will be sort of relatively similar. It starts at the same value, it starts at A, and the only difference is this 2B. Up here we have minus B times Q, here we have minus 2B times Q. So the question is 2B or not 2B, if you want to recall it like this. How can we compute the marginal revenue? In fact, in order to put it correctly into the table, we have to do two things. First of all, marginal revenue is always defined. Marginal is always defined by the change of the total. We had this with costs, and it's the same here. So it's from 0 to 12, the change is 12. From 12 to 22, the change is 10, and so on. That's what we have to compute. 12 minus 0 is 12. 22 minus 12 is 10, and so on. When we put this down, we get marginal revenue, which is not completely correctly located in our table. It might be a bit technical here, but if we think about the change between 0 and 12 is 12, but this 12 belongs here between the lines. In order to draw correctly, what we have to do is to make an average out of these two, so that we then have an 11 here and a 9 and so on. So we do the average by saying this is 12 plus 10 over 2, which is 11, and we can put this function down to the end without the last one. It's not filled, and we can add a 13 up here, so that our function in fact really starts at the same beginning. Right? It's the same A. A minus B times Q is the blue function, and that goes down until 13. And A minus 2B times Q is the red or orange function, intersects the axis at 6.5. So marginal revenue in fact can and does take negative values because it measures the changes in total revenue. So when I start with a quantity of 0 and I increase the quantity to 1, 2, 3 and so on, the quantity goes up. But then it's, and this is what the marginal revenue shows. There are these increases on that side here. There are the increases whenever I go 1 in the Q direction, then how much does it go up? And we see that this is positive here. Here are the positive developments, and then here are the negative ones. Once we have the maximum, the marginal revenue, the change in total revenue is 0. And then after this, it's negative. Or mathematically speaking, we know that the first derivative has a value of 0 when the function itself, the total revenue, has the maximum. And that's something, we knew and we have been using also to optimize things. And this is sort of, we illustrate it again here. By adding this dashed line, we can see a bit more that the maximum is in fact between 6 and 7. And that's the point where the marginal revenue intersects the Q-axis, where the marginal revenue is 0. Comparing this to the theoretical or to the numerical example we had, our next step is described at this total revenue, maximizing the total revenue. And here we come back to chapter 2, elastic and inelastic parts of the demand function and the relation between total revenue and marginal revenue. Let's have a look at these elastic and inelastic parts of the demand function. I would be happy if you recall from chapter 2 that we had these parts of the demand function, and we said the upper part has an elastic demand and the lower part has an inelastic demand. In chapter 2, we described this with the relative effects, that in the one case the quantity effect is bigger, in the other case the price effect is bigger. Here we can directly see the functions, and we also see where sort of this middle is. It's this maximum of the total revenue function. So this, in fact, helps firms to make decisions. Let's have a look at this. There's another numerical example with which our authors illustrate this. The numbers are a bit different, but it's the same story, we could say. Marginal revenue going down, marginal cost being like this. So the marginal revenue is this downward sloping line, and the marginal cost, you might recall, is a more or less U-shaped. It's a bit shorter, the one edge, and then goes up. And when we compare these two functions, we come to the profit maximization, because when we compute marginal revenue minus marginal cost, then for small quantities, it might be that there are positive distances, and this is sort of marginal revenue minus marginal cost is the marginal profit, the profit of producing one more unit. But then this will turn around at a specific point, and from there on, the marginal profit is going to go down. Which means that we come here to an output decision which is similar to the one we talked about in chapter 2, where we said what to do in order to maximize revenue. Here we go one step further and we talk about how to maximize profit. And we see that the profit also has a shape like this. And if we are in the lower part, the output decision is we should raise the output so we have more profit. And if we are in the upper part, if the quantity is so high that in fact the marginal cost is bigger than the marginal revenue, then we should lower our output. And we can see the profit function here, that the profit in fact in the middle is the highest one. In our Miro board, we can now bring this together. I copied here the numerical examples, the two tables, and the analysis we made from Excel. As I said, the Excel file is also available for you to reproduce what we have been doing. And when we now say maximizing profit is total revenue minus total costs, we have here the shape of total revenue. And what was the shape of total cost? Here we have to go back to chapter 3. In fact, chapter 3, the first video. So when we go there, firms in the marketplace, background to supply, and we go here to the right-hand side, we can look at the derivation of the total cost and also bringing this together with the costs per unit. And let's take this graph and combine that graph with our total revenue that we can look at. So from here we only took the total cost function in the typical shape and can now bring this together with the total revenue function. And now when we say total profit is total revenue minus total cost, we can see the profit in fact here. We can see that there are areas where a positive profit is made and that there are areas where a loss is in fact made. We have to compute the difference between this upper function, the total revenue, and the lower function, the total cost. So the vertical differences that we could sketch in such a way, these are positive profits that we observed. Whereas to the left and to the right of these thresholds, in fact, there will be losses realized. Here the loss increases rapidly, but in there we have the profit, and in fact the highest profit is, if sort of to do it by eye, might be that value, that quantity that we used to call QM, the profit maximizing quantity. We also see that the profit maximum is not the maximum of the total revenue, nor is it the minimum of the total cost, but it's always the difference between the two. Combining this analysis with the costs per unit or the revenue per unit or profit per unit down here, we can see that these three parts can be reflected down here, especially the part where the profit is at its maximum. That's the point where marginal revenue equals marginal cost. When we bring this total analysis, total revenue, total cost coming together to total profit with the cost revenue per unit, then we see that this maximum of the profit, what we called QM, is exactly the point where marginal revenue intersects marginal cost. To sort of bring these two together, here total cost, total revenue, of course we can also draw a total profit function. The profit becomes positive here, has its maximum, goes down there, and shows a well-defined maximum. So we derived a graph where we can see the profit maximization, total revenue minus total cost, either in the total dimension, and then this is our profit function with the maximum here, and that maximum can be described also at the point where marginal revenue, the downward sloping, is equal to marginal cost. What is shown at the end of this part 5.2 in our book is this graph to say at the point where marginal revenue is higher than marginal cost, it makes sense to increase the output. If this turns around, if marginal cost is higher than marginal revenue, it makes sense to decrease the output. And that brings us, in fact, exactly to the middle, to the profit maximizing quantity. We can see this here or here, that marginal cost is below and then afterwards higher, and marginal revenue is higher and then afterwards below. That is exactly the graph that we have here. Okay, moment of break or whatever. But this video contains more parts. It also contains the parts 5.3 and 5.4. 5.3, the spectrum of market structures. As said in the introduction, in fact, whether a firm is able to maximize the profits, which we now analyzed intensively, depends on the market structure. And this market structure is something that most of you will be aware that these differences exist between a situation where there are many buyers and sellers, which is a competition, and in the ideal case we call it perfect competition. The other extreme, monopoly, where there is only one firm and we don't have any choice where to buy, but it has to be that one firm. And market structures in between that we call imperfect competition. And imperfect competition is, for example, an oligopoly, a situation that we call monopolistic competition. And this is now sort of pure definition. What is perfect competition? What is monopoly? That's something I'd like us to do together in class to find out what are the conditions and what are examples. So let us take that as a homework or a classwork in order to be filled in class to describe these different market structures. Might come as a bit of a contradiction, so this we leave to do this in class and change to the next subtopic, which is 5.4, talking about perfect competition. And yes, here we already get a bit of the answer to the question before, but only a bit. We are going to see that also here we can think about examples. What is it that is meant with homogeneous products, many buyers and sellers, and so on? And what does that mean? What does perfect information mean? What does no transportation cost mean? Is that realistic? What kind of model is that? This is also something we are going to discuss together because the definitions are there, they're in the book. And the point here is to ask ourselves, okay, so what does that mean from point of view of the firm concerning, first of all, their decision, their production decision. So, yeah, the supply on the one hand, and then the question whether this firm can realize an actual profit or not. The first thing that is in fact strange in perfect competition is this, that it says demand equals average revenue equals marginal revenue as a horizontal line. This is shown in figure 5.3 and also explained there. I'd like to do it step by step in order to understand what the rationale is. And in fact, I normally turn it the other way around. So let's do this. Let's say we have on the one hand the situation, the normal market situation as we have been describing it. In the big markets, there are many buyers and sellers, and we have the normal situation that we have been dealing with, a supply function which is upward sloping and a demand function which is downward sloping. And this is the normal situation, and then there will be an equilibrium price and an equilibrium quantity as we are used to from the last chapter. And we might be back at selling pizza or whatever. The difference between the big market is that then we talk about a huge amount of pizza that are produced and sold in an industry, whereas compared to a small firm that might be a pizzeria making the pizza by hand and so on and selling individual units, some hundreds, some thousands, but far away from producing millions. So that might be the equilibrium at 3 million, if this is 1, 2, 3. And let us assume the price is 10 euro, just as an example. On this market, the typical things apply that we have been describing. So if now a new supplier or a big chain of, let's say, a pizzeria restaurant chain enters the market, then there would be more supply, there would be a right shift of the supply curve, and the supply curve would move here, and we had quantity supplied too, which would lead to the prices going down and the quantity traded on the market going up, as we discussed in chapter 4. But this depends on, or this relies on the assumption that this firm that enters the market is really big. If it's our one small firm that can offer, let's say, a maximum of 4,000 pizza, the quantity supplied curve is not going to change at all. It was before here, and then afterwards it might be here as well, so that at the end we don't see a real difference. And this is what makes the special thing of firms in perfect competition. Still we have this headline here, perfect competition, with these characteristics, these key assumptions that we have here, that this one small firm has to accept this market price. And that's now the situation that was described before. This is the price on the market. These are the 10 euros. And if the small firm has to accept this price, then it's the price it gets, the revenue that it gets on average for every unit. And if for every unit is equal, then this is also the marginal revenue. So average revenue, marginal revenue is reflected by the price here. Because, and this is something we are going to discuss later on, what we assume and what we can assume under these conditions here, firms have no market power and so on, that this price, these 10 euro, the equilibrium price, is the price that where it makes sense for firms to produce. That this is the price that covers the costs and makes the production profitable on a normal level that we are going to describe later, this normal profit. But you cannot make more than this. You cannot make more than normal, which means if the 10 euro describe the actual costs, then this firm can never take more than 10 euro, because then nobody is going to buy this. And it cannot take less than 10 euro, as 10 euro is the production cost. And so selling for less than 10 euro, the firm is going to make a loss and can no longer exist. Now we ask ourselves, how can this small firm maximize its profit? And we come up with the same answer we have been deriving at the point where marginal revenue equals marginal cost. The MR function is already given, so it depends on the MC. We know the shape of MC is this small going down and then going up. That's a typical MC curve. And our firm would now decide to say, okay, I maximize my profit by looking at that point where marginal revenue is equal to marginal cost. I go down to the quantity, I compute the quantity for this, and that will be my QM, my profit maximizing quantity, which is the optimum. It's the best profit that they can make, but that doesn't answer the question whether this profit in fact is positive. The profit maximization might as well mean that the firm has to make a loss, but minimizes the loss. This is also a result of our optimization. Marginal revenue equals marginal cost. Mathematically speaking, we had to check not only the first order condition that the first derivative are equal to each other, but we had to look at the second derivative and check. But we can do this easier in a graphical way. Let's think about our definition. Profit is total revenue minus total cost. And here we are looking at marginal and average terms. So we can represent total revenue as average revenue times quantity and total cost with average cost times quantity. We already have our average revenue because we said this is average and marginal revenue is all represented here for a small firm in a big market, so for a small firm in perfect competition. We know that the average cost is U-shaped, looks a bit like this. And the question is now, where is this average cost located in relation to our QM, to our profit maximizing quantity? If the firm is lucky and in fact the average cost is below average revenue in this situation for QM, then this firm is going to realize a profit, because we see the revenue in sort of this rectangle here. And we might compute this. We said this is a price of 10. That was the price from the market. And the quantity, the easiest case, is 1,000. Then our average revenue times quantity gives us the total revenue of 10 times 1,000 of 10,000. Whereas the average cost is obviously lower here, it might be 8. And then we have this red rectangle, 8 times 1,000 for the total cost, which gives us a profit of total revenue minus total costs, 10,000 minus 8,000, and we get a positive profit of 2,000 in this situation. That works if the production technology and following sort of the costs of this small firm are that way that in this optimum, in fact, the revenue per unit is bigger than the cost per unit. And if this is the one case, if the profit is possible, then also there might be another case where the firm is going to end up making a loss. By the way, when we draw this, keep in mind that the average costs are intersected by the marginal cost in their minimum. So this point where the two intersect is always the minimum of the average cost. And that means here that at quantity M, the average cost of production is higher than the average revenue of production. So let's draw again the cost and the revenue. cost is now up here, so higher than the average revenue, and the average revenue will be the smaller part. So up here we see the loss that has to be realized in such a situation. Showing the profit here on the left-hand side and the loss on the right-hand side. We can also compute this by searching for numbers. We know that this is the level of 10, and let's say then the average cost is 11. So we can compute the profit down here. With a total cost of 11,000, and then the profit is 10,000 minus 11,000, so makes a loss of 1,000. We can also see this here. This is 1 times 1,000, so that's why we can show the profits here as areas in our diagram. This situation, this analysis is also shown on our slides 18 and 19, depending on where the short-run average total costs are located. We have a profit maximization or we have a short-term loss. A last definition that is different in economics from typical business analysis is that if we look at these costs, then it's typically economic costs are the accounting profits plus a return to the owners, to the shareholders. And here we differentiate between a normal profit, the minimum that is required to keep the firm in the industry, so to stop the firm from shutting down, and what is called supernormal profit. And supernormal just means in excess of normal profits. There is this figure in our book where we see that the difference sort of between accounting and economic profits is not that big. Both compute revenues minus costs, or less costs as it says here, and the costs are related to the production factors, land, labor, and capital. So raw material, wages, depreciation of capital gives us the accounting profit. And if an accounting profit is 0, then this firm doesn't make a profit. And nobody sort of earns, the shareholders will be not content, and so on. Whereas the view of the economist differs by this small thing here, but that makes all the difference. Return to the owners. That the owners of the company, that can be a private company, a little shop, let's say a small shop or a small restaurant where the owner works, then she is going to have all these costs, have revenues, have all the costs, and typically if she runs a restaurant, she's going to say, and I also need money to make a living. This return, and I want to earn 4,000, 5,000 a month. And only then I call this profit. Or I call the firm profitable. I'm going to keep on running this firm. If economic profits then are 0, it still makes sense to keep the firm in the industry because the owner is already earning an income. And this owner can be the single person who runs a restaurant or a shop, but it can also be a large company, and then it's the shareholders who ask for their remuneration, the dividends, interest payment, but especially dividends that are paid. Also, these are returns to owners. But that is why in economics we typically say in perfect competition, normally all supernormal profits are competed away so that firms only make normal profit, and normal profit is at the end here, the economic profit that are down there of 0, because they exactly cover their costs. Nevertheless, it makes sense because they already earn a living in this definition. And there are some more situations in our book described. We don't want to go into all the details, but it means, or it says that at the end we typically end up in this situation here, that marginal cost equals average cost equals this price equals marginal revenue equals marginal cost. So we come into a situation where it seems that there is no profit or no supernormal profit, and only with our definition of economic profit, it makes sense for firms to still produce in this situation. So in our graph, that would look like this. In the long run, in perfect competition, all supernormal profits are competed away, but nevertheless, it makes sense for firms in perfect competition to produce at this condition because they have their income covered. But of course, on the other hand, this is not sort of such a nice message, because firms would like to make higher profit. And that brings us back to the thought of the different market structures that we have been looking at. We now had an insight into perfect competition, and in class we are going to discuss these different market structures. In perfect competition, a relatively low profit, but typically a relatively high quantity. And let's discuss this in class. Let's find out the different results that come from our assumptions that we take into account here. That is it for this video. The next slide will be about monopoly, Chapter 5.5, when there is one firm. And yeah, I'm looking forward to seeing you back, or to having you back. I don't see you here in the video. And in between, we are going to discuss this in class. And I hope there will be questions. I hope there will be remarks and even controversial discussions. Does this economic analysis of different market structures, and especially of the situation in perfect competition, make sense from your point of view? Let me know. Have a nice day.